Your money-making broadcast starts now. Good evening. Today is June 1st, Monday. Here are the top stories moving the markets. We are witnessing a historic moment as the S&P 500, Nasdaq, and Dow Jones all surged to new all-time highs, with the S&P 500 finally cracking the psychological 7,600 barrier. The catalyst? A positive ISM manufacturing PMI reading that confirms the bull market is not just surviving, but expanding into a new phase of growth. Let's get straight into the numbers. The S&P 500 closed at 7,599.96, up 0.26%. The Nasdaq climbed 0.42% to 27,086.81, and the Dow Jones added 0.09% to finish at 51,078.88. All three are at record highs. However, it wasn't a clean sweep. The Russell 2000 fell 0.47% to 2,905.76, showing a clear disconnect between small caps and the giants. In the volatility space, the VIX rose 4.77% to 16.05. While still in the stable zone, the rise suggests some investors are buying insurance. The U.S. 10-year Treasury yield eased slightly to 4.455%, creating a friendly backdrop for equities. In commodities, Brent crude is trading at $95.30, up 0.34%, while gold remains steady at $4,514.80. Bitcoin continues to track the overall risk-on sentiment of the market. Our first and biggest story today is the explosive performance of Salesforce, ticker CRM, which skyrocketed over 10% to close at $210.93. This wasn't just a random pop, it was a calculated reaction to the ISM manufacturing PMI coming in above 50, which signaled a robust expansion in economic activity. Javas analysis indicates that the market is now pricing in a massive surge in AI-driven CRM demand. When enterprises see a strengthening macro environment, they accelerate their digital transformation budgets. We saw 11 major news events surrounding CRM today, including a maintained target price of $225 from Citi. For investors, the implication is clear. We are moving from the AI hype phase to the AI implementation phase where software companies that can actually monetize AI are seeing massive premiums. However, from a strategic standpoint, the Java system took a bold step today by fully exiting the CRM position at $210.10, locking in an 18.03% profit. While the trend is bullish, the system detected a divergence where the VIX rose 4.77% despite the record highs, suggesting that smart money is starting to hedge. This is a classic sell the news maneuver at a local peak to preserve capital for the next dip. Moving to our second big story, the AI infrastructure build-out is entering a gargantuan new phase of funding. A major tech leader has announced plans to raise a staggering $80 billion through stock sales to fund its AI infrastructure. To add more fuel to the fire, Warren Buffett's Berkshire Hathaway has invested an additional $10 billion into this company. This is a massive institutional vote of confidence. When you combine this with Hewlett-Packard Enterprise, ticker HPE, which saw its stock jump 30% following its biggest earnings beat since 2018, the narrative is undeniable. AI servers and networking demand are exploding. HPE's results prove that the hardware layer is still seeing massive growth, not just the chips. We are seeing a ripple effect where NVIDIA's new chip debut is reigniting momentum across the entire semiconductor sector. Broadcom, ticker Broadcom, rose nearly 3% on the back of its new broadband AI chip. The data shows a clear rotation into quality AI, companies with real balance sheets and proven revenue streams, rather than speculative startups. Finally, let's look at the broader macro picture and the Federal Reserve's looming shadow. We are currently on day 39 of this bull run. Historically, these cycles tend to last between 42 to 49 days before a meaningful correction. With the S&P 500 at 7,600, the tension is palpable. The 10-year Treasury yield dipped slightly to 4.455%, which is generally a green light for risk assets. However, we have a fragmented market. While the big three indices hit records, the Russell 2000 actually fell 0.47%. This tells us that the everything rally is over and we are now in a quality rotation phase. Investors are fleeing small caps and hiding in the megacap fortress. Furthermore, geopolitical volatility remains a wild card. President Trump's comments regarding Iran talks have kept Brent crude oil elevated at $95.30 per barrel. This energy volatility is likely why we saw a sharp 5% drop in Meta and a 4% slide in Tesla today. The market is becoming extremely selective, rewarding infrastructure and punishing high-valuation consumer-facing tech that is sensitive to macro shifts. Let us examine the CRM story in greater depth. A 10.38% single-day surge in a company valued at over $200 billion tells us something profound about the market direction. The ISM manufacturing PMI coming in above 50 was the immediate catalyst, but the underlying driver is the enterprise AI adoption cycle. Salesforce has been aggressively integrating AI agents into its CRM platform, and the market is now pricing in a revenue acceleration that goes beyond traditional SaaS metrics. This is not about customer relationship management anymore, it is about AI-driven customer intelligence. The Java system recognized this fundamental shift early, riding the position from entry to a disciplined exit at $210.10. The 18.03% profit is locked in, but the decision to exit was based on several diverging signals. The VIX rose 4.77% to 16.05 even as indices hit records, indicating that professional money is hedging against a near-term pullback. Additionally, the RSI divergence on CRM daily charts suggested momentum was peaking. This is textbook sell discipline, let your winners run, but have a thesis for when to take profit. On the AI infrastructure front, the synergies across the sector are remarkable. Hewlett-Packard Enterprise jumped 30% today following its biggest earnings beat since 2018. This validates the thesis that AI server demand is not a one-quarter phenomenon, it is a structural shift. HPE reported record AI systems revenue, driven by massive deployments from cloud hyperscalers and enterprise customers alike. The company order book is extending multiple quarters into the future. Meanwhile, NVIDIA gained 6.07% on the back of its next-generation chip debut. The new architecture promises a 3x performance improvement over the previous generation, which would compress AI training timelines and expand the addressable market. Broadcom added 2.95% following the launch of its broadband AI chip, designed specifically for high-speed data center networking. Together, these moves paint a picture of an entire ecosystem firing on all cylinders. The $80 billion capital raise, with a $10 billion anchor investment from Berkshire Hathaway, is the capstone. The Oracle of Omaha does not deploy $10 billion on a whim. This signals a multi-decade megatrend in AI infrastructure spending. The quality rotation is the most important macro theme to understand. While the S&P 500, Nasdaq, and Dow all set new records, Meta Platforms fell 5.07% and Tesla dropped 4.02%. Both companies have outsized exposure to consumer discretionary spending, which faces headwinds from elevated oil prices and a potential shift in Fed policy. Brent crude at $95.30 per barrel is squeezing household budgets, which directly impacts advertising revenue for Meta and vehicle demand for Tesla. The market is saying that high-valuation consumer-facing tech is vulnerable, while AI infrastructure plays with real earnings and institutional backing are the preferred destination. This is exactly the kind of rotational environment where the Java's cash-heavy strategy excels. With 93.1% cash and $107,074 in total portfolio value, we have the liquidity to deploy into high-conviction setups when the broader market corrects. The bull market is 39 days old and the historical peak window of 42 to 49 days is rapidly approaching, making this defensive posture not just prudent, but essential. For investors constructing their own portfolios, the Java's framework offers 4 distinct approaches aligned with different risk tolerances. The Canadian Pacific Kansas City Railway at $122.67 represents the ultimate safe haven in a frothy market. Railroads have pricing power, essential service demand, and minimal exposure to the AI hype cycle. With an 8.9% gain and a stable dividend yield, CP.TO offers exactly what balance sheets need when the VIX is rising. Carnival at $27.62 is the contrarian recovery play. The travel sector has been beaten down on recession fears, but the ISM data today suggests the economy is expanding, not contracting. An 8.2% profit on a name that was deeply oversold shows mean reversion in action. Broadcom at $459.97 is the high-conviction AI infrastructure pick. The broadband AI chip launch positions Broadcom to capture the networking layer of the AI stack, which is a multi-billion-dollar opportunity as data centers upgrade their internal architectures. Finally, AMD at $510.13 is the value play in the semiconductor space. While NVIDIA dominates the headlines, AMD long-term R&D roadmap positions it to capture meaningful market share as hyperscalers push for supplier diversification. An 8.5% profit on a name that did not participate in today's rally as much as it could have is actually a buying opportunity, because the fundamental thesis remains intact. The jobs data gauntlet this week is arguably the most important macro event of the month. Tuesday brings the JOLTS job openings report, which has been a reliable leading indicator of labor market tightness. Wednesday ADP employment data will give us an early read on private sector hiring. But the main event is Friday non-farm payrolls. If NFP comes in above 200,000, the market will interpret that as the economy running too hot, reinforcing the higher for longer interest rate narrative. That would likely trigger a sell-off in the record high indices, particularly in the high multiple names that have fueled this rally. Conversely, a NFP print between 120,000 and 180,000 would be the sweet spot, confirming a soft landing without reigniting inflation fears. The ISM manufacturing PMI already above 50 gives the Fed cover to hold rates steady, but a hot jobs number could change the calculus overnight. The VIX at 16.05, while still in the stable zone, has been creeping higher for 3 consecutive sessions, which is precisely the behavior we expect to see ahead of major data releases. The bull market is on day 39, and the average cycle peak of 42 days means we are in the danger zone. A hot NFP on Friday could be the trigger that ends this leg of the rally. Looking ahead to next week, keep your eyes glued to the economic calendar. We have a gauntlet of data points coming our way. First, we have the JOLTS job openings report on Tuesday, followed by the ADP employment data on Wednesday, and finally, the main event, the non-farm payrolls on Friday. Given the current strength of the ISM data, the Fed is in a tight spot. If employment remains too hot, the higher-for-longer narrative could return, putting pressure on those record-high indices. We will be monitoring these prints closely to see if the bull run extends to day 45 or if we hit a wall. That is all for today's deep dive. We have locked in our profits and moved to a defensive posture, but the opportunity in AI infrastructure remains massive. The Java system has been meticulously tracking every data point, and the signal is clear. We are at an inflection point. The ISM manufacturing PMI reading above 50 is a powerful confirmation that the economy is not just avoiding recession, it is accelerating. This is precisely the environment where a disciplined, cash-heavy strategy outperforms. By holding 93.1% cash in a portfolio worth $107,074, Javas has delivered a 7.07% return while positioning itself to deploy capital when the inevitable dip arrives. Stay disciplined and watch the data. We will see you tomorrow. To recap today's session, we have a paradoxical market. Indices are hitting record highs, yet the VIX is climbing and the Russell 2000 is lagging, signaling a shift toward high-quality, AI-integrated giants. Our portfolio strategy has pivoted aggressively to defense, moving to 93.1% cash to protect gains as we approach the historical 40-day bull cycle peak. Now, let's dive into our 4 strategic stock recommendations based on the Javas analysis. First, for a safe-type play, the legendary father of modern value investing, Benjamin Graham, would choose Canadian Pacific Kansas City, CP, at $122.67. This is a low-volatility defensive play with an 8.9% gain, providing a necessary safety margin and stable dividends while the rest of the market remains volatile. For a balanced-type approach, the legendary Wall Street fund manager Peter Lynch would choose Carnival Corporation, CCL, at $27.62. Despite a price target downgrade from Truist, the stock maintains an 8.2% profit. He would see the current dip as a reasonable entry for a recovery play in the travel sector, blending growth potential with a stabilizing floor. For a growth-type aggressive play, the world's leading innovative fund manager Cathie Wood would choose Broadcom AVGO at $459.97. With the launch of its broadband AI chip and a current profit of 5.8%, this stock is the epicenter of the AI infrastructure boom. She would prioritize the company's dominant position in the networking layer of AI. Finally, for a low-cost, high-upside play, the legend of growth stock discovery Phil Fisher would choose Advanced Micro Devices, AMD, at $510.13. Although it dipped slightly today due to Nvidia's dominance, the long-term technicals remain strong with an 8.5% profit. He would focus on the long-term R&D capability of AMD to capture the remaining AI market share as the industry diversifies away from a single supplier. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.